All right. Well, welcome everybody to today's session, the Q1 summary and looking ahead. For those of you that are taking time out of your day on a sunny day, appreciate it. Thank you very much. We're going to cover off a few different topics today. And I'll be speaking, I'll try and keep my chat today for about 35 to 45 minutes. If you do have questions, if you could just put them in the chat box, send them over. I will answer some questions at the end of the session. In the meantime, like I said, if you have questions, otherwise you can email me thereafter. But again, once again, thank you for joining us, and we will get started. So three key areas that we'll talk about today. Number one, and first and foremost, will be the Q1 2023 summary. So really 4 areas that I'll speak about: inflation, interest rates, global banking panic, obviously what happened in the US. And then I'll also talk a little bit about the recession, where we keep hearing this, the recession discussion. And then I will give a few comments about the overall markets. I didn't include it as a point, but I will share a few slides there. And then I'm going to jump into the US banking headwinds. I'm going to actually spend probably about 5 to 10 minutes. We've been getting a lot of conversation about, how is it going to affect the US or the Canadian banks and our portfolio. So I'll spend some time about what actually happened, what we're anticipating, how it's affecting the big 6 banks. And then I'll just give a couple of last minute tax comments. Obviously, everybody's in the final stretch here as we file over the next 2 to 3 weeks. Last minute ideas, making sure that you're trying to capture all the deductions that you can. All right, so already kind of 4 key topics here, and it's fresh. US just came out with their data, their CPI data this morning. Canada just came out with it within the last week, and inflation is heading in the right direction. It is trending downwards, and both in Canada and the US, inflation numbers came in lower than what was expected. Okay, when we look at Canada, Canada is now at 5.25%. Peaking June of last year. And the US is actually under 5%. This is as of this morning they reported. We anticipated to continue to trend downwards. If you were to look at inflation numbers since June of last year, they probably come more in line with around 3%. Target inflation is between 2 to 3. So there's a lot of work to still go. Biggest thing here, and I'm going to move on to interest rates in a second, but you can see how quickly the US or the Bank of Canada has increased interest rates here, starting early last year and then into this year. Again, no surprise that the tipping point in inflation coincides with the increasing or rapid increase of interest rates globally. So this is just a recap for those of you that have joined on the last one, but the interest rate outlook coming into this year, when we look at the big 6 banks or the big 5 banks, and then also the BC Real Estate Association, most analysts or economists felt that when I say we, Canada, was in line for 1 more rate hike likely, maybe 2. And then there was going to be a period of pause while the Bank of Canada reassessed the economy. So we did get that first rate hike of the year. The Bank of Canada just came out today, second announcement in a row where they're actually holding rates. So the game plan or the playbook of the Bank of Canada is right on track. If anything, we might see another rate hike, a small one, but if anything, we could see a plateau throughout the year and then even potentially start reducing as we head into the back end of this year into early next year. Now, in the US is a little bit different, okay? Their inflation was a little bit higher. With the way it came down today, we might likely see them pause a little bit more. But the US Fed, the Federal Reserve, has actually come out and commented and said, hey, rate hikes are still on the horizon for us. Despite the overwhelming idea that rate hikes were going to slow, they actually, before a month ago, they actually said that they could hike anywhere between 50 to 1.5 basis points, okay, which is 0.5% to 1.5%. Now, when we look at the outlook for the US based on kind of forward-looking data, and here's where we are here, April, May, this is the likelihood of rate increases, which they did hike, 25 basis points just, a month ago or so. But, the overwhelming response or overwhelming outlook is that, it too, or the US Fed will slowly start to cut rates. Okay, they will plateau. But one of the issues that we're actually seeing, the reason why they're not taking the same stance as the Bank of Canada, is that employment numbers are extremely sticky. And what I mean by that is the whole purpose of increasing interest rates is to try and slow the economy, because the economy is overheated right now. That's why inflation has got to where it was, mid last year. So what the central banks try to do is they increase interest rates to take money supply out of the economy. Because what happens is instead of spending it on goods and services, we're spending it on debt and so on. So they raise interest rates. While typically when interest rates go up, we tend to see unemployment creep up as well. That hasn't happened this time around. And when we look at the US unemployment number, we can see right here, it's at a, over the last 20 years, it's at a low. It's actually at almost an all-time low for unemployment. So we haven't seen that spike. The last time we saw it, obviously, was in COVID, that very short period of time. But currently, there is more job creation and vacancies in jobs than what the US Fed is happy with. So they were talking, this is the reason they were talking about increasing interest rates to continue to try and hold off job growth. Because if job growth remains in the economy, it means people have more money to spend, which could derail their action plan to actually get interest rates or inflation rates under control. So that was about a month and a half ago. Well, we all experienced, and again, I'm switching gears here to talk about the U.S. banking, crisis or panic that happened, with Silicon Valley Bank. And I'm going to spend probably about 5 or 10 minutes talking about this specifically. So I'm just going to give a high level overview here. So US Fed was coming out saying, hey, we're going to hike. And then we went through this kind of financial headwind with Silicon Valley Bank. And because it actually put the economy a little bit on edge, they actually came out, the US Fed, and said, hey, we likely won't hike as aggressively as what we thought as recent as a few weeks prior, because they didn't want to tip the economy into a really difficult situation. So essentially what happened is, we had this US banking crisis, Silicon Valley Bank, which was the second largest, I almost call it a default, but failure of a bank outside of Washington Mutual. And what happened is a lot of these regional banks, these smaller banks, investors or depositors were concerned about some of these regional banks as well. And just to put your mind at ease as I continue to chat, things have cooled down in the financial sector in the US, just simply because of the actions that the US Fed, the Treasury, and FDIC has taken. Okay. Now, it wasn't just in the US. We also saw Credit Suisse. They merged, or UBS bought them roughly a month ago. Now, for a lot of folks, they might think, hey, the first shoe dropped with Silicon Valley, and then Credit Suisse was the second one as a result. The reality with Credit Suisse, for those of you that haven't followed it, is Credit Suisse has had a long, slow death. Okay, there was talk a year to 2 years ago about this exact same thing happening. And if we look at their market cap, the size of the company, the value over the last 6 years, we can see it's been gradually falling over time. And it was between 40 to 50 billion in 2017. Well, when we looked at the end of 2022, it was only just over $10 billion. That's a significant decline in value. And then here on March 19th, when UBS bought it, 3.2 billion. So again, lots of issues within the financial sector, a month ago. But as I mentioned, things have actually settled down. And some of these things that are happening, again, Credit Suisse, it's not a surprise to see them being bought or merged with another European bank. Okay, so I've talked about three: inflation, interest rates, banking headwinds or crisis in the US, and I want to talk about recession as the last one. So these are the four items that, is top of mind for us. We're cautiously optimistic about what's happened thus far this year, but I still believe a recession. I don't know how Canada or even the US, they skirt going into a recession. And I've been talking about this since last July, so almost 9 months. I do believe that we're going to enter into some sort of recession, even if it's minor. Okay. Now, what I'll show in the third slide here about recession numbers is it is backwards looking data. So when they do announce it, they're not going to announce a recession today. They're going to say, hey, we've looked at all the data and the recession started 6 to 8 and however many months previous. Okay. But there are some indicators about why, we could enter into a recession. So the first one here is just the lending standards of a lot of the big financial institutions. Okay, and if we look back, 2008, we look back here in the 90s, 2020, anytime banks or financial firms, they tighten lending, which we're seeing right here, generally it's followed by a recession. It's somewhat of an indicator that things are starting to grind to a halt. Now, for a lot of you, we've probably had conversations in the past about getting a line of credit against the home. This is the specific reason why. So again, I'm going to walk back that comment. So when we talk about getting a line of credit potentially against the home, we think about it from a planning point of view. So for a lot of folks on this call, one of their biggest assets they have is their house. Okay, property values in Vancouver and the Lower Mainland have actually spiked significantly over the last decade. And so what happens is the ability for you to access cash off your house is zero if you don't have a line of credit against it. And so what we've suggested since 2008 and 9, which is when the last of this really happened, notwithstanding 2020, coming out of 2008 and 9, we suggested for a lot of clients to start looking at actually having a line of credit available. And the purpose of this is for a couple of things. Number one, if you need short-term cash needs, you can actually access it quickly. Number two is if for whatever reason you were buying a second property or you needed some bridge financing, you could access it immediately. And then number three is, get it when you don't need it. Because what happens now is for folks that are actually getting into the real estate market or they need to do some lending, banks are actually lending much more strictly now. So for some folks that have good credit and a good file for them, they might not be able to get it. So again, we really encourage that conversation to say, hey, here are the reasons. Let's put some planning in place to actually help you for various stages throughout your life. The next slide here is, again, the most anticipated recession from a GDP projection. So again, this is looking at a lot of different analysts and forecasters. If we actually look, this here, it just says, hey, what's the probability of having, negative GDP growth? And if you go back to the 90s, tech wreck in 2000, 2001, and then even the financial crisis, we see these big spikes, okay, of the forecasters saying, hey, we think that we're going to have negative GDP growth in the future. Well, look at where we are today. So we're trending very similar to previous recessionary times. So again, it's not an accurate predictor. And when I say that, it's just saying, hey, no one of these data points are going to predict a recession. But when we get a lot of them kind of coupled together, it just leads us to believe that we could likely get a slowdown and even a recession announced. So this is what I was mentioning earlier, and I've shown this slide before, and I think this is really important. And again, for those of you that have seen this, bear with me, 2 minutes here. I'll just recap it for those that haven't. So what this chart shows you, NBIR is a National Bureau of Research, okay? And these are the folks that actually help call recessions. And so if you actually look back over a period of time since the 1980s to now, there's been several recessions. And what they've done is they've actually looked at when the recession started versus when it was announced, okay? So if we actually go here, I'm going to talk about 2008 and 9. So the red bar, this signifies the length of the recession. Here's where it started. Here's where it ended, okay? The green bar here, this is when it was announced. So what's interesting is the recession started here, but they didn't announce it until almost a full, 8 months later on average. And if we actually go back on a lot of the recessions, even back in the early 2000s, same thing. Recession started, months before it was announced, and it was actually over sooner. Okay. Now the same is true. So I'm talking about when a recession is announced. Well, the same is true when a recession is announced that it's ended. Generally, what happens is the markets start to accelerate long before a recession is ended. And I'll give you an example. And I wish I had this chart in here, but I'll give an example. FedEx. Everybody knows FedEx. Okay, you probably get lots of packages from FedEx. Well, about a year ago, they came out, and this is how you can think about markets when they decline. FedEx came out about a year ago, and they said, "Hey, we see some challenges within the economy on the horizon. Okay, we actually anticipate our profits to go down. Not as many people are going to be shipping items, so we actually anticipate just a slowdown." And what happened to their stock that day? It dropped between 12 to 15%. Not when the slowdown happened, but immediately when they made guidance earnings, okay, or earnings guidance. Well, what happened just recently is they came out and said, hey, we actually see positive news on the horizon. We think profits are going to be better. We anticipate a pickup in our business. Well, lo and behold, what happened is their stock went up sooner than later. It goes up in anticipation of future earnings. So similar to the recession, markets lead us in as things kind of get darker on the horizon. And then as we're in the midst of this slowdown, things get better, long before we're out of that slowdown, because all these companies are looking in the future saying, hey, we actually think our earnings and our profits are going to be greater in the future. Okay, so let's just be mindful when a recession is announced that, again, this is generally how things work out. Okay, now I'm just going to switch gears here. We're going to talk about general market comments, just spend a few slides, and then I'm going to jump into the US banking, which, like what I said, is top of mind for a lot of our Canadians or our clients. So first one, I just want to comment on about the markets in general. So over the last 18 months or so, if you actually look at month over month growth of the markets, we've gone no more than 2 consecutive months of positive market growth. So what I mean by that is that we'll get 1 month where it's positive, second month is positive, third month is negative. Okay, and then we might go through a couple months of negative, and then we get another positive month, but they haven't lasted longer than 2 consecutive months in almost 18 months. So the challenge for a lot of investors is it's, 1 step up, 2 steps back, or sometimes it's 2 steps up, 1 step back, but it's been quite choppy over the last 18 months. So this is just a good reminder. And again, you can go back into any financial book or what have you, and they talk about the cycles or the emotion of an investor. And I don't think that's really necessarily our families, because our families are very pragmatic and diligent with how they actually invest their money. But in general, what tends to happen is, when it's at the bottom, a lot of people it's kind of doom and gloom. They're run down, they're beaten up. And so they're just nervous. Okay. And then as the markets start to go up, again, there's a little bit of skepticism in general. And when things start to get really good, that's when everybody wants to be buying, when the news is the most positive. And what happens is at peaks, the same thing happens. They start to go on this ride. And when they get down to the bottom, the same thing. It's the opposite emotion where people say, oh, you know what, I'm going to sell. It's been a long grind. And that cycle goes on and up and down. And probably the best example in recent memory is crypto, or Bitcoin. There was a big run up as everything was increasing last year, and it hit a peak and it's had a sharp sell off ever since. Okay. Now I'm not suggesting everybody runs out and goes and buy digital currency, but things are starting to rise up again. Okay. So with markets in general, with asset classes, whether it's real estate, stocks, digital currency, or what have you, everything is cyclical. So that's why it's really important that you take a more diversified approach to balance out your risk and get those more consistent and predictable returns. So what's happened this year? So the markets have actually started out quite positively. Q1 was actually positive overall, despite February and March not being great months. What was interesting, though, is when you look at the S&P 500 that posted, this again wasn't the end of March, but gives you an idea. At the time this chart was done, S&P had posted a 3% gain. But what's interesting is when you look at the top 5 holdings, again, all technology, Facebook, Amazon, Apple, Microsoft, and Google, well, these are ones that were really beat up last year. The NASDAQ was down 33% last year, and all of these would be considered your growth in tech stocks. Well, this year, the S&P 500 returned 3%. These 5 were up 19% on average. The other 495 stocks that trade on the S&P 500 return an average 0%. So that means some were flat, some were down, some were up. But on average, those 495 companies contributed 0% to the 3. Okay, so again, this gives you an idea. It's a very concentrated market, more so than what it was in the past. A lot of these tech companies that were a smaller portion in years past have become a little bit of a larger portion. But again, this year, a lot of the growth on the markets have come from tech companies, which are the most beat up last year. Okay, and most of our clients own these investments, whether individually or through ETFs or pools or what have you. So they participated on this upside as well. Now, again, here's a good chart. When the S&P 500 returns, a similar return to what we saw this year of 7% or greater, and this has happened, if you go back to the 1950s, it's happened a handful of times, probably 15 times, give or take. Well, when this generally happens, the full year return of the market has averaged roughly 20%. Now, folks, I'm not suggesting that the S&P is going to finish at 20% this year or 25%. But again, it's one of those things that we say, hey, you know what, if we look back on what's happened in the past, it's a good indicator of maybe what's going to happen in the future. So there are a lot of analysts out there that are expecting the S&P 500 to post probably a double-digit return. And again, it's just the mere fact that we're coming off a year last year when the S&P 500 was down 20%. Okay, NASDAQ was down 33% last year. So again, there's a lot of good value in some of these companies that as the economy picks up and it gets again better on the horizon, they're going to start to pick up steam as well. So the next thing I just want to touch base on is just valuations. Okay, so valuations, you know, if we look at companies, you can actually look at what their historical valuations are, their PE ratios and so on. And we can go back and say, hey, what have they been in the years past and where they are today? And how can we actually compare them? So to give you an example, you know, if we go back to 2008, and I'll talk about our Canadian financials since it's kind of top of mind in the topic, you know, Canadian financials in 2008 were trading at 6 to 7 times earnings. Okay. Historically speaking, in 2008 and 9, the Canadian banks traded at 14 to 15 times historical average. So here they are at 6. They trade at, you know, 14, 15. That actually is an indicator that they're significantly undervalued. You know, BMO, Bank of Montreal, back in 2008, was paying a double-digit dividend. I think it was around 12 to 13%. So just on that data alone, you could look and say, hey, things are so cheap right now. Even if we're buying and it's not exactly the bottom, we believe if things trend back up to the historical average, you know, we're going to have good gains. Well, if we look at where we are today, again, if you go back, this is COVID here, but here's where the valuations were pre-COVID, which was the highest it had been in, you know, almost 20 years. Well, through the pandemic, we saw a significant spike in overall valuations, and then we've seen this significant contraction. We haven't seen valuations at this level since almost 2013. Okay. And then previous to that, it was back in 2003. So the nice thing about valuations is, you know, when you look at the average, the valuations currently are actually below where the 25-year average are. So they're actually reasonably priced. They're not significantly discounted, but they're not as overly expensive as what they were as much as 3 years or even 2 years ago, which again is another positive sign. And then when you look at sentiment, and I like this chart, this one I just came across, JP Morgan did a presentation recently, and this is part of their PowerPoint. Well, if we look at various negative sentiment, and we go back again over the long run, we can actually see the average upside when the sentiment reading gets down to a bottom. The average upside is 25%. And we can see this, you know, 1975, 1980, 1990, all these various periods of time. Well, here's where we are today as of the end of last year. Okay, now it would be up a little bit higher, but it's still at a low that we haven't seen in almost 11 years, 12 years. So again, just like we talk about the recession readings about why we might go into a recession, the same is true when we look at the markets in general. Last year was the first bear market we had had in almost 13 years. So there's a lot of reasons why we actually think, you know, looking forward, you know, markets are going to be in a much better place in a year to 2 to 3, if not even sooner, than where we are today. And the last two is just a reminder. And again, I think it's really important, you know, as we see some of these ups and downs in the markets, we bring it back to putting things in perspective. Okay. Again, I showed the S&P 500 rather than the TSX, which I'll talk about in a second. S&P 500 is the most diversified market in the world, 500 companies. And so when you look at the S&P 500, which is 100% stocks, you know, these are the returns year over year. So very sporadic, very up and down, but you get an average, okay, when you actually blend that out. And when we look at the periods of time over the last 50 odd years, when we look at 1-year periods that were positive, 80% of those times in the last 50 odd years, S&P posted a positive return. Well, if you went out 5 years, then it was 84% were positive. And the longer you stay invested, now some people might say, hey, I don't have 20 years to stay invested. But again, the more time you have in the market, the more of the outcomes were positive. Okay. Now, I also came across this statistic that I thought for those of you that would say 20 years is too long, you know, here's another perspective on a shorter scale. So again, this is a rolling 20-year return. But if you actually look across the bottom, the number of years, the longer you've actually stayed invested, the lower probability that you've actually had a negative return. So instead of 20 years, here's an example where after 13 years in an actual balanced approach, you actually have pretty much in every situation that they run have come out positive. So again, it's not timing the market, but rather time in the market. All right. So I'm going to actually wrap up with this last slide on markets, and I'm going to move into the Canadian and the banking sector, which again, I think is a good topic. So here's a really good example. It goes back to 2008, 14 years. Again, you can chop it up any period that you want, but these are all the various asset classes of the returns on the TSX. And what's interesting is, again, what it does is if you look at 2008, which again, we had that significant downturn, fixed income was the best performing asset class. Okay. You had here emerging markets, which was the worst at 53.2 on the negative. Okay. If I pick another random one, here's 2017. Okay. One of the best performing asset classes that year was emerging markets. Okay. Then large cap, small cap. And then down here, cash was the worst. Cash was at 0.8. And what's actually interesting, if you look at cash is almost always one of the worst performing asset classes out there because interest rates were so low. Now, this year, what's going to likely happen is cash is going to be a little bit higher. So you can see in 2022, when markets were really choppy, cash was one of the better performing asset classes. This is a good segue because we're coming across a lot of folks that have cash balances in their bank accounts and they're getting 1 to 2% from their financial institutions that they're with. Folks, we can actually get anywhere between 4 to 5%, probably closer to 4.8, through different cash vehicles that are available to our clients. Okay. They're fully liquid. We can cash out. Money goes back to the families within a 2 to 3 day period. A lot of people have asked me about GICs. GICs will actually only pay you marginally more, but lock you in for at least 1 year. Okay. So there's a great opportunity to make sure that your cash is working on a regular basis. Now, the purpose of this actual chart or this slide that I wanted to talk about, again, it's very difficult to pick, back-to-back winners in terms of the asset classes that do well. So when we look at it from an asset allocation point of view, if you actually took a blend of all of these, this is what your asset allocation, this is what a blended portfolio would have performed over the last 20 years and year over year. So on average, over the last 14 years, 6%. But last year, an average balanced investment would have been down 14. Year before would have been up 13 and so on. So again, similar to the other slide that I mentioned, you got to go up and down to get that average. It's no different than any of these other asset classes out there. Okay, so again, goes back, we can concentrate the portfolio, but you're sticking all your eggs in one basket. Okay, good example, if we had bought, the commodity ETF last year, we would have posted a gain of 16% while markets are down. This year, you'd be down 2%. Okay, and even in here, back in 2012 to 2015, in Canada, this is why the TSX has struggled so much over the last decade, because commodities, which are roughly a third of our market, have not done overly well. Again, almost over the last 10 years, they've actually ranked in the bottom 9 periods of time where it's ranked in the bottom 1 to 2 asset classes. Okay. All right, so let's move into the U.S. banking and talk a little bit about how this might affect our Canadian banks and, more importantly, how it affects you. So I'm going to specifically talk about Silicon Valley Bank, and then again, I'll give some reference on the Canadian side. So first thing is, for those of you that aren't aware, or maybe those of you that saw the news, so Silicon Valley Bank was headquartered in California, and they've been around for almost 40 years. Okay, so nearly half of U.S. venture-backed technology and life science or healthcare companies banked with Silicon Valley. So one of the first key takeaways is their customer, the depositor base, was not overly diversified. Okay, and what we saw coming out of the pandemic, if we look here, this is 2018, 2022. Well, in this period of time, the last 2 years, they've had significant deposits. So they've had a lot of money come into the bank. Okay. Well, banks are profitable companies. They need to make money. So they need to invest it. They're not going to have money, just like our clients, where we recommend to try and maximize cash holdings. We don't suggest that you just have it sit in your bank account, because you'd be your bank's happy, or you would be the best client for the bank. You have money in your bank account, a significant amount. They're paying you very little. and then they lend it out in a mortgage for 5, 6, 7%. Okay, they're making the spread. So same with banks. What they do is they get their money, and then instead of just having that money sit in cash, they invest it to make, a return on that cash that's sitting there. So Silicon Valley Bank. So to give you an example, they had 211 billion of assets. Okay, and they had what was called, and I'm going to come back to this after, but they had this roughly 14 billion of common equity tier one, which meant kind of liquid capital. Okay, now the majority of their investment securities that they were trying to make money on, it was invested in two types of securities or two types of portfolios. The first one was this roughly 29 billion of available securities that they could sell if they needed, okay, in order to facilitate withdrawals. And then they had this longer term, almost 92 billion, that was what was called held to maturity securities. So what that means is they would have invested it in maybe a bond or a US Treasury that they would invest today, and they would receive interest on it. And let's say it was 5 years or 10 years. Well, in 5 or 10 years, it would fully mature and they'd get their money back, plus all the interest over that period of time. Okay. Now, the value of that will go up and down. And we've seen that in the Canadian bond market. As interest rates have gone up, bonds have significantly slid. Well, it's no different than these US Treasuries that they've invested. Okay. So what essentially happened, which triggered the run, is on March 8th, there was investors that were wanting to, or depositors that wanted to get money out, and they didn't have enough liquid cash. So they had to sell this first portfolio. And unfortunately, they had to actually crystallize this 1.8 billion in losses because they didn't have time. They had time to let it accrue and mature at full value. Okay. So I'm going to give you a visual example. So what they did is they invested it in these treasuries. Okay. And if you remember back, bear with me one sec. If you remember this slide, here's all of the deposits coming in after sub 2000 or post 2020. And here's how they would have invested it into these treasuries, these longer term treasuries, to get as much yield as possible. So here's the growth, before interest rates started to go up. And then remember, interest rates started to go up right around here. And they had this significant sell-off. Now, this 15%, by the way, you can disregard that because that's the value of increase since, back in the early 2000s. Really, if you look at what happened, here in 2020 to, current, there's been a significant loss in value. Now, again, the loss doesn't happen unless they have to sell it. Okay. So essentially what happened is the depositors came, said, we want to take out our money. They sold that first portfolio, and then they tried to raise capital by selling stock. And both of those were red flags for a lot of the people that kept money in there. So what happened is they went to the bank and said, hey, we want to have our money out. And it just snowballed. So the problem with Silicon Valley, okay, it was concentrated customer deposit rates, long duration of fixed rate securities. And the biggest issue is they did not hedge their interest rate. And what I mean by that is they could have actually bought different types of investment vehicles to actually offset, the interest rate going up. It just didn't happen. Okay. Now, when you look at the unrealized losses in comparison to Silicon Valley versus the big six banks, it's much different. Okay. So if we go back to what I just said, Silicon Valley had, 14 billion in liquid cash, but their losses were 15 billion. They have more losses than they have cash to give out. So Silicon Valley had a CET1 capital percentage of 111%. And I know I'm talking a little bit more technical, folks, but it's important to understand what caused this. Okay. Now, when you look at our banks, TD, BMO, Royal, CIBC, National Bank of Nova Scotia, the average a tier one ratio versus the ability for liquid cash is only 9%. So much different. Okay. And TD and Royal, the reasons why they're a little bit larger is because they have a much more significant US operation than some of these other banks. And sorry, TD and BMO. So overall, our Canadian banks are much more capitalized than Silicon Valley. So when people say, hey, will it happen here, to what happened with Silicon Valley? Highly unlikely. Okay. And the reason why is, we only have 6 big banks. They represent 45% of our Canadian market, the TSX. And not to say they're too big to fail, but it's highly unlikely that the Bank of Canada and the government would actually allow any one of our major banks to fail. Okay. And I just want to actually make a couple more points, lots of data on here, so I'll keep it high level. When you look at in the US, when you look at the actual withdrawals of some of the US banks, they experience actually a decline in deposits. So more people taking money out, okay? Whereas when you look at our Canadian banks, we actually see growth in deposits. So here's a good example. On the last quarter, the US deposits declined 4.1%, Canadian deposits went up 1.7%, okay? The other thing is Silicon Valley, they weren't subject to what they call liquidity coverage ratio. They didn't have to make sure they had specific amounts of cash available. Whereas Canadian banks, they have to have high quality liquid assets, okay, for the purpose of withdrawals. So I think the thing is the key takeaway is Canadian bank depositors or deposits are much stickier and far more diversified than Silicon Valley, okay? They're all domestic banks. They're all governed a little bit differently. We have much stricter regulation than what the US financial system does. And we saw that in 2008. 2008, we saw significant bank failures in the US. In Canada, not one of our banks failed. And, on average, they would make about 12 to 14 billion of collective profit a year. So their profit was down because of everything that was happening. But I believe off the top of my head, they still did probably 6 to 7 billion in profit. So they just did less profit. Okay. So our banking systems through one of the worst financial crises of our time were very stable. And when we look at just, again, the big six US bank or big six performance versus US banks, if we just look between March 9th and 13th, which is when a lot of the issues came full steam ahead. If we look at the US banks, these are two ETFs, okay? The two ETFs, US bank ETFs, both regional and then the big banks were down between 20 to 25% in that 1 week. Well, if we look at our Canadian banks, they fared very well, okay? Down anywhere between 4 to 7%. Okay, now keep in mind the overall markets were down as well. So partially this decline was due to the financial situation in the US, but it was also partly to do with just overall market trend as well, okay? So I'm gonna wrap there. If you guys have questions about that, I'm more than happy to talk more about it. Again, I believe our Canadian banks are in sound shape. They're all paying between 4.5% to 6% in dividends right now. I think the biggest issue that we need to be aware of as investors and also as folks that manage money, if all of a sudden we get negative news in the market, I don't think it's gonna be so much contagion where all of a sudden our Canadian banks are having the same issues. But I believe what will happen is if the general financial outlook globally is negative, it's going to indirectly affect our financial system here in Canada in terms of market price. But again, I believe they're on quite sound footing. So, all right, folks, I'm going to just do one more slide here about tax season, about some things that you might want to be considering. I'm sure most of you have probably already filed or are in the process of filing. A couple just comments. Most of everybody on this call should have your tax slips. If you don't, again, you can follow up with us. We can help you out and if needed. I know we've been in contact with a lot of you, including accountants. We're in the home stretch. So by all means, if you guys need anything, just let us know. So a couple of things on the last minute tax filing tips. So number one, I don't think this would apply to anyone here, but big stress is obviously be timely. We don't want to see anybody have late filing penalties. They're stiff. CRA loves to dip into your pocket and take a little bit of extra cash. So if for whatever reason, folks are late or extended late, 5% penalty on the taxes owing plus 1% for up to 12 months. And that could get aggressively worse the longer it goes on. Okay, so again, I don't think that's a big issue, but a good gentle reminder. Number two, don't forget to deduct carrying charges. So again, safety deposit boxes, interest deductions on properties or borrowed money. Let me talk a little bit about this. We still come across folks, whether it's with our families or just new introductions, where they've used money for the purpose of buying a property, or maybe they've used money for the purpose of buying some sort of investment for the purpose of making money, earning income. And people aren't deducting their interest costs. So keep in mind that actually, if you are in that situation, you can take that interest or that carrying cost and you can deduct it. You can deduct it on line 221. Okay. Now, if you're unsure, talk to your accountant to make sure that they're aware of it and they can provide guidance, or ask us, send us an email or what have you, and we can actually give some comments as well. Because there's no sense in not using that deduction if you can, deduct it directly against your income. Number 3, again, claims for the sick and disabled. Again, medical expenses, disability amounts, caregiver amounts. They're often overlooked completely or they're underclaimed. Okay, so I think one of the big ones, if you happen to be caring for maybe a family member, maybe it's a parent or what have you, and there's medical costs associated or caregiver costs, if you're filing your own taxes, you may actually be overlooking some of the deductions that you might be able to get. Okay, we have a lot of families that are actually pressed up against that old age security clawback. And I imagine in a lot of cases, they're trying to get as many deductions as possible. But if you're not working with an accountant or a tax professional, you could be overlooking some. So again, if any of these items might apply to you and you're not quite sure if they're applicable, just reach out to us or again, go back to your accountant and just double check. Okay. And then the last one here, interfamily transferable provision. So this is all about income splitting, guys. So again, spousal amounts, tuition, educational credits. Sometimes you can actually use tuition and educational credits instead of for the child. You can actually have it go for the parents that are higher income earners. So again, these are all things that you should be speaking to a tax or a professional about trying to manage your tax situation and get as much tax deductions as possible. Now, folks, these are just 4 of the more recognized items that can be overlooked. There's probably another 5 to 10 that may or may not be applicable to you, okay? Now, in most cases, maybe they aren't, but again, you don't want to leave anything on the table when you're actually filing your return, okay? So again, any questions, feel free to reach out, send an email. The full team is here. We can help out, no problem whatsoever, okay? So listen, I'm going to actually open it up for questions. I appreciate everybody sticking around. I appreciate you guys taking time out of your day. I hope you found this useful. We will actually put this together on a recording and we'll send it out. But again, I think just to summarize, like I said, I think the markets are in a much better spot where they are today. There are a few things that we are closely watching, mostly those 4 key ones at the beginning. From a recession point of view, that chatter could pick up. And I said, just be mindful of it. Don't get too caught up in it. If you do have questions, feel free to reach out. And we'll do this again in 1 quarter. We'll do it again in Q3. We'll circle everybody else back around. And if any other ones come up, we'll definitely keep everybody informed. So again, thank you again. I'm just going to actually look through here. We do have a couple of questions and feel free to be writing them in as well. You just put it right in the Q&A box. So, all right. So I mentioned it earlier, but I do have one here, and it's a question where they've said, "Hey, I do have cash in my bank account. I have some cash in my bank account. It's short term. I'm just leaving it in the bank because I don't want to invest it in the markets. What's the best thing to do?" So, and folks, this is a great question. Actually, we're getting this one on a regular basis, and we're investing a lot of folks' cash just into short-term interest yielding vehicles. So, what I mean by that is, as an advisor, okay, we don't have any one specific bank or financial institution we have to use for securities or investment securities. So we get regular updates of RBC, TD, Royal Bank, Purpose Investments, CI, and so on, where they come in and say, "Hey, anytime there's an interest rate change, hey, this is what we're going to be paying in our short-term investment vehicles." So one that we use right now is through CI. It pays roughly 4.8%. I personally use it. Okay, it's been very consistent. And it's a pool where they actually take advantage of all these major institutions, mostly the banks. But because it's a $4 billion, actually it might even be more than that now, it might even be 6, but because it's such a large pool of assets, they can basically buy on wholesale. They can get way better rates than what you and I can walking in and investing, our nominal amount of money with the bank. So what they do is they pool it together, daily liquidity. We carve it out. It sits there. You earn, like I said, between that 4.5% to 5%, which we're happy with. It is variable rate because it fluctuates with interest rates, but it has no market exposure. And when folks need it back, we just sell it and send it back to them. Okay. So again, just one idea. For others, they might say, "Hey, I'd rather buy 5, interest-bearing investments from each of the banks or 6 of them." We can do that too. We can buy BMO, we can buy National, we can buy CIBC, we can buy all these various ones directly at the banks as well and create that pool. We're likely not going to get quite as high of a rate just simply because we're buying at the retail level versus the institutional level. Okay, but lots of great ideas. So if you have $100,000 and you're getting 1% or 2%, that's $2,000 a year. If all of a sudden you get 4.5 to 5, now you're getting 4,500 to 5,000. So it's a no-brainer. We had a fellow corporate account had 7 figures just sitting in cash, earning next to no money. We're now getting them close to 5%. Okay. So again, if you have questions or if it makes sense for you to do it, let us know. If it's operational cash that you just use on a regular basis, we're not suggesting it to move back and forth. But if you're sitting on balances, whether it's inheritances, you sold a property, what have you, it's a great opportunity to maximize your return on your investment. Okay. Yes, sorry, really quickly, CI. So somebody just asked, can you clarify? CI is just a financial company, no different than TD Asset Management, RBC. CI Investments is a investment company. It's local. It's I should say it's local. It's massive. It's North American. It's one of the biggest investment institutions in North America. So, of course I should have added this. So thank you. So somebody asked Canadian versus USD forecast. I usually have a slide. So we have actually seen a little bit of a move. Early in my session in Q1, maybe it was late last year, we talked about the direction of what we thought the Canadian dollar would be. Most forecasters feel that the Canadian dollar will appreciate against the US dollar throughout this year. We saw that trend at the beginning of the year, and then the US dollar is, anytime we see volatility, the US dollar tends to appreciate because it is deemed one of the safest currencies in the world. But there's a lot of things going on right now. You're seeing a lot of countries that are moving away from the US dollar in terms of trade, making it a little bit less desirable, but it still is the biggest economy in the world. So based on where we are today, we still feel the Canadian currency will likely appreciate, and has in the last couple of weeks, as we've seen it actually move forward. So sorry, somebody was asking about safety deposit boxes. I believe those are fully tax deductible regardless if you're earning income. Hopefully you're not earning income in it, or you're not earning income with the safety deposit box. I might have some questions about how that's happening. But yeah, I believe safety deposit boxes are 100% deductible. We'll just double check with the accountant. So, okay. Any other questions from here? I'm just waiting. Sorry, guys, just bear with me. Okay, I think actually we're pretty good. I think we had those 3, which was ideal. If you guys have other questions, like I said, feel free to email us, reach out directly. There's a lot of financial uncertainty, I think, that people are seeing right now. And what I mean by that is just emotionally, as investors, me included, it's been a long, drawn out, 18 months, give or take. This market volatility or downturns started in late 2021. And generally, they tend to be kind of compressed a little bit more. That's what we've experienced. 2020, even 2008, 2008 and 9, it was a tough time. But really, the volatility happened between September and kind of February. So kind of through 5 months. We're at 18 months. And so I think it's just the perception, the feeling is that it's been a long grind, and it's just, when will this end? But it has somewhat started to end. For those of you that saw my Global Mail article that came out about 2 weeks ago, they were asking about, where do we think we are in the bear market? So generally and again, looking back at the S&P 500, the S&P 500 bear market was announced in June of 2022. It's now been roughly 9 to 10 months since then, okay, give or take a month. Well, the average bear market on the S&P 500 is generally roughly between 8 to 10 months, which is where we are today. So I believe we're probably in the middle to the end of this actual cycle. And if we look at where we have been in the first quarter, where markets have actually gained back some of the declines they had last year. Again, I believe the next couple quarters could be telling for what's going to lie ahead for the next year to 2 years. And again, we tend to see some really rapid increases when things start to stabilize in the market and things start to go in the right direction. So again, hang in there. You guys are doing the right things. We're still on track from a retirement forecasting point of view. We're going to look back no different than 08, 09, 2020, 2018, and recognize that this is just one of the years that have happened, amongst a number of very good years. So, okay, so I'm going to wrap that there. Again, thank you very much. If anybody has questions, again, feel free to reach out. My email has been up there now for the last 5 minutes, and you guys have it anyways. All the best. Obviously, hopefully we get some good weather here between now and into summer. Hopefully we'll get through this cold weather. And yeah, like I said, look forward to chatting with anybody. If anybody needs anything, just let us know. All right, have a great day, folks. And we'll talk to everybody soon.